Small Caps is partnered with the Australian Stock Report. Looking to make better investment decisions? Visit australianstockreport.com.au.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Everybody, welcome back to ausbiz live from our Barangaroo studios. Friday afternoon, we kick off the PM as usual with The Call. 10 stocks picked by you. I put those stocks to our expert panel. We do it all in 1 hour, and it's Friday. Thank goodness it's Friday, the 5th of August. Got a lot to get through today, and I love these two blokes because they're always full of great information. Luke Winchester from Merewether Capital and Claude Walker from A Rich Life. Afternoon, gents. How's your week been?
Great, thanks. How about you?
Yeah, Luke, are you buoyed by the uplift in the market, and particularly some of those tech stocks, or do you think it's don't get too carried away?
Well, I mean, if you give me the option, Koshy, of July versus, the first 6 months of the year, I'll always take the up month. Look, I think everybody's still a little bit pessimistic on the rally. It feels, bear market rally, relief rally, dead cat bounce, whatever you want to call it. It feels a little bit like that. Look, what I would say, though, is that a lot of the fundamental updates, we're in earnings season over in the US. We're about to enter the bulk of our earnings report in the next couple of weeks. Most trading updates have been pretty good. So I think, the earnings cliff that people, I guess, are a little bit worried about because, we've seen a lot of other indicators already roll over, and the next one in line sort of, corporate earnings and profits. So far, we haven't really seen it, but of course, that's a backwards looking indicator. We're getting, the US's last quarter. We'll get the last 6 months for these businesses. So I think the forward outlook will be very important this reporting season. So we'll wait and see what most companies say. But look, I am buoyant if want to call it that way. I think so far so good, and we'll wait and see what the outlooks look like.
Caught a bit of a theme from the panels on the call in the last week or two has been really like the bounce. Not sure whether there's another leg down, but this bounce back is a good opportunity if you've still got any crap in your portfolio just to get rid of it, because it's looking a whole lot better than it did in June.
Yeah, I think that's a reasonable take, I guess. I haven't personally been using this bounce to take anything off the table yet, because most of the stuff I had real questions about I already reduced in position size. There's a few stocks. I think one of them we'll talk about today, actually, which I have actually been bag holding as it is. I'm down quite a bit on that one. And yeah, basically at the moment, I still think that we probably still have the second half of this story, which is perhaps an earnings recession where actual earnings estimates and stuff come down.
Yeah.
And until then, I guess people will be a bit jittery and I will be a little bit cautious.
Yeah. Guidance in this reporting season, I think, takes on certainly a new importance. Hey, let's take a look at the first 5 stocks we're going to get through this half hour. Smartgroup, OFX Group, Propel Funerals, 8 Common, and also Volpara. And stock of the day, we've been a bit cheeky and asked because it's a bit thin on the reporting season at the moment for today. Ask the guys for their Friday buy, if you like, in terms of small caps. And interesting, you've both come up with health-related stocks. Look, you've gone for global health that delivers sort of a digital health solution company.
Yeah, so we've both got sort of that medical software space. Global health, I won't shy away from it. It's been the ugly stepchild of the medtech space. Koshy, compare it to, Pro Medicus, which Claude knows inside out, is the gold standard. But even like a Mac 7, Alcidion, which Claude will talk about. Global health is even a tier down from those guys. But that being said, it's a stock I've held for a while, but have recently sort of really grown some conviction in the near term outlook, but also into that sort of medium longer term as well. And the reason for that, it's not a true turnaround business, but it was probably a business that had some untapped potential. And a new CEO has come into the business, Michael Davies, his name is, and his background is from Macquarie Telecom. Macquarie Telecom's been such a fantastic business listed on the ASX for many, many years. He was Chief Revenue Officer at Macquarie Telecom and brought some real, enterprise sales experience to the business. And when he came on board about 12 months ago, he was pretty honest with the market, said that, he had to put some structures and processes in place, and it would take him 12 to 18 months before you really saw the rewards come through. The market was probably a little bit skeptical at first, or certainly took a step back and said, we'll wait for the signs that it's actually happening. But I'll give him credit. I think you're starting to see that now. They've had a really good run of contract announcements over the last month or two. In and of themselves, individually, they're not, big material, large contracts, but add them all together. And the business probably has got circa 25 to 30% revenue growth locked in over the next year or two. Just from these contracts I've announced recently. So, I think it's a bit of a play on new manager coming in who's really going to unlock the potential of the business. And a bit of momentum now over the last couple of months, giving me that extra conviction to sort of go from a hold to more of a buy.
Interesting one. Claude, yours is Alcidion.
Yes, that's right. So perhaps a little bit more of an established company than Global Health in the sense that it's got bigger and revenues essentially, and also operations established in the UK and Australia. Basically, I've written a lot about it on the website if you want to find out what it does, but basically it does workflow and hospital management to help get better, faster outcomes in terms of who needs to be in what bed, have they had the right tests, have they followed up on those tests, all that kind of thing. You can clearly see that there's a growing demand for it, and that is the nice bit about investing in medtech, because you have this sort of mix of a sort of defensive industry in health with potentially sometimes you get really good growth and good economics in these software companies as they can add new customers, and one would hope don't have to spend too much money implementing that. So it's relatively low cost expansion there. So what I like about Alcidion at the moment, similar, I was cautious on it. The last 6 months, all of these cash burning growth companies have been hit hard, Alcidion included. Yep. I've been fairly cautious and negative. Even the last time I talked on Ausbiz about it, I was sort of saying, I kind of like it, but not quite sure. We need to see if it gets to break even. Well, what happened is in its most recent quarterly, it had its strongest quarter ever in terms of free cash flow and also receipts from customers. That's a really strong sign. The company's talking about being basically break even, one would hope, from now on. Perhaps not every single quarter, because the September quarter does tend to be a little bit weaker than that June quarter. So it may not be a perfect run from here, but I think it looks like the company's crossed over into cash flow positive. I would hope to see perhaps not a profit in FY 2023, but certainly I would be hoping as a shareholder for a profit in FY 2024. We could see it making that transition from, I guess, the really high risk, loss making growth stocks to more of a profitability, profit growth company. And that's what I'm interested in. So I actually bought some more shares yesterday. I already held some.
Oh, okay. All right. Two interesting stocks to take a look at. All right. Thank you for that. Let's get into the stocks that you want us to cover. And Claude, Julie wants a view on Smartgroup. And Julie says, we bought Smartgroup, much higher price, watched it fall after someone tried to buy them out. I thought at least it must be a good company. Now I'm having second thoughts and thinking it's time to sell, although it does pay a good dividend. It's in salary packaging, fleet management, payroll administration, that sort of area. Claude?
Yes, that's right. So Julie makes a good point about the dividend. I'd say that's probably the number one reason that I'd own the company, and it does occasionally pay special dividends as well. So it can be quite generous yield there, but that's not always guaranteed. We also have a situation here where you'd argue the stock might be kind of cheap on its earnings, and that's because the nature of its business relies very heavily on novated leasing, which is essentially a process people go through to obtain a vehicle at lower expense, especially to the employee, that relies on, buying it basically through their company and having a lower taxable income as a result. And basically the result is that you get a bit of a cheaper vehicle. I don't think that this business really needs to exist for society to function in any way. It's just a feature of the way the fringe benefit tax is run in this country. A few years ago, I think it was 2013, Labor were thinking of getting rid of this sort of arguably regressive tax system and just having no incentive for this novated leasing to go on, basically. And so as a result of this risk, which I have no idea what the political risk is that would happen again, but because of that risk, this stock sometimes trades a bit cheaper than it might deserve to. But that's also the kind of risk that I don't really love to play with. It's not my bread and butter. I'm trying to look for secular growth stories that are going to compound and create value over, even the ideal would be a multi-decade situation, but at least 5-10 years. This is a different kind of situation. I would look at it in terms of the dividend, but for me, it's just not my cup of tea at all.
Okay, all right, Luke. It's had a bit of a bounce since the horrible June, has it?
Yeah, well, June they announced the loss of a major customer, Koshi, the Department of Education and Training in Victoria. Management said it represented about 5% of their revenues, and that's a bit of a orange flag for this business because historically, it's a mature, almost steady state business, and it relies on maybe low single digit growth, but you've got a pretty locked in customer base that they generate some pretty healthy margins and definitely some very healthy cash flow, as Claude alludes to, pays a very good dividend. So you see the loss of a key customer, and that sort of raises just a couple of alarm bells. Either there's maybe more competition in the space from a Macmillan Shakespeare and SG Fleet, whether that could lead to further customer losses, or more likely maybe just lower yields across the space if there's going to be more competition on price. So little alarm bells there, something to keep an eye on. But I generally agree with Claude. I think this is a mature business. It trades on, call it roughly 13 times earnings, but it'll never trade higher than that, as Claude alludes to, just with that regulatory risk. We've seen it play out once. And it just doesn't have the same growth profile it had, rewind 5 years ago when there's a lot of acquisitions to be made. So I think you're there for the yield. I think if you're happy with 6% as a standard, but as Claude said, cash can accrue on the balance sheet, and if there's no acquisitions to be made, you'll get a good special dividend every maybe 2 or 3 years. So if you're happy with the yield, I think you can easily own Smartgroup. Just be aware of the regulatory risk and keep an eye on those customers also. But if you're there for capital growth, I'll probably look elsewhere, Koshi. Okay. All right.
So a hold if you're in it, but certainly not new money. All right. Luke, Ben wants a view on OFX Group, the big online international payments group, foreign exchange services for consumers and business clients. Interestingly, Carl Capolinga from Think Markets about 45 minutes ago here on ausbiz was running through some sectors and financials, and he particularly likes the OFX chart at the moment amongst all the financial plays.
Yeah, well, I mean, I'm no chartist, but when I brought up the chart, I was shocked. This is a business that's performed really well. Not just through July, like most have bounced, but even through the whole of the year, as the chart shows. Yeah, it's had a good year. There's not many charts like that aren't maybe in the coal or oil space. So I was pretty surprised when I saw it. I did actually remember seeing their annual report. I think they report to a March financial year. So I think I saw their report back in May and thought it was quite strong. But even so, that chart still surprised me. I actually think a part of it, Koshi, may be people sort of may be viewing OFX as a bit of a hedge on market volatility. The reason being is that March 2020, when COVID sort of first hit, was actually the best month they've ever had in their company history. So it's a business that can do well when you've got geopolitical volatility and money needs to move quickly across borders, when enterprises in particular don't want to be holding certain currencies for too long and want to bring everything back to their home currency or maybe vice versa. So I think maybe there's some of that. You've got all these geopolitical tensions right now, and we've seen OFX can perform well during those periods, or certainly sort of grow the business strongly. On the back of that good run, I struggle to get too enthused, other than, as Carl points out, the chart looks very good and the momentum's there. Fundamentally, that valuation has now really started to creep up there. On just a reported earnings, it's probably up towards sort of 26, 27 times. They generate really good cash behind that, though. So I sort of backed out a bit of a cash profit, and I still have that about 15, 16 times, which is good. I think that's a fair price for the business. But a bit like Smartgroup, I don't think there's a business that's going to give you, 20 or 30% profit growth into the next few years. It's a bit more of a mature, steady business. They've really got to work hard to keep and win customers, because it's such a tight space, that commodity exchange. So I'd hold it if you're there. The momentum's good on the chart. For anyone looking on the sidelines, I think that price is just a bit up there, so I'd wait, maybe a bit of a pullback.
Okay. What do you reckon, Claude?
I'm almost laughing just listening to Luke say all that, because it's as if he went inside my head and took all the good bits and then said it more eloquently himself.
Oh, that's scary.
All I can really add is that, when I was looking at this a few months ago, I was highlighting it on ausbiz, if you look it up in June, saying, look, there was also a bit of director buying at $2.20, and I highlighted it in a segment, pretty much hitting those same points Luke did in terms of the feature of the business model benefiting from the current macro climate. The only other thing I would add is, for me, it's more of a sociological trade about those kind of factors. I don't have a great deal of long-term confidence that this is in a really good business, and that it's going to be a good business with great economics that compound for many years. We can see its long-term history on the ASX. It has been up and down over the years. I think it is a little bit at the mercy of the cycle. Sometimes that benefits it, sometimes it doesn't. And I do think it's a tough competitive business. So pretty much exactly agree with Luke, just adding a little more thoughts on the long term there. I don't think it's great, but I think this sociological trade is playing out. So all right. Luke said it all, really.
Claude, Henry wants a view on Propel Funeral Partners. They describe themselves as in the death care services business, which is funeral homes, cremation, cemeteries, and all that sort of infrastructure. Did I read the other day they'd bought a pet cremation business as well? That's in Cairns. That is that is a massive growth area for all of these death care services business, funeral directors. Massive increases.
Yeah, look, I imagine it is. That doesn't surprise me. Obviously,
and
that's
good
a very
margins.
small part. I didn't know about the margins in the pet cremation. I guess it's quite small compared to the overall business, but you could definitely see them getting growth there. And also, they've been expanding in New Zealand. And I think that really the story here is expansion via acquisition. So you could almost argue that what the corporate entity does, it doesn't just run funeral businesses, it also just goes out and constantly buys them. And I think that's both the risk and the opportunity. This is a fairly classic roll-up, but whereas some roll-ups have super obvious synergies and super obvious benefits of scale, this one perhaps not quite so much, and also it's quite a capital-intensive business with you have all the facilities and the equipment and all of that kind of thing. So overall, it doesn't have those business features that make it stand out as a potentially high-quality compounder over many years. However, the general idea is if they can buy the businesses from the private market at the right price and then bring it into their business, get a little bit of benefit over having greater scale, then it could work and create value. And, that's what sort of seems to be happening at the moment. The share price is close enough to all-time highs, really, if you look at the long-term history of the business. For me, this is one that you could definitely buy on an attractive dividend yield, basically, because as we know, the demand for their services should be pretty solid. Obviously, it was hit actually by the pandemic because people couldn't gather for funerals. But going forward, you'd sort of expect over the long history of time that demand is going to be strong. So at the right price, on the right dividend yield, it'd be one I'd look at. Right now, it's just too high for me to be interested in this kind of business. Not saying it's a bad business. It could be a hold if it's just a super long-term dividend hold.
Okay. Luke, what do you think of Propel? The other big things we had in the small caps a couple of months ago, one of the bosses of these and they were saying that there's the big push to having licensed premises, so you can have the wake at the funeral home as well, and because everyone wants a party when they go now.
Yeah, well, it's funny, Koshy, because you open up these presentations, it feels a bit weird, right? Because they talk about average revenue per funeral and all these metrics that you sort of think, we're talking about people that are dying here, but you're right. I mean, they find ways to, have value-added services, I guess, and that's certainly one of them. The pet funerals is another. So I give them credit for that. Look, I think I agree with a lot of what Claude said. I'm not a big fan of roll-ups, and Propel is definitely at the lower end of, even that industry, because you look at their presentation, they talk about the businesses they've bought, and they're all just separate, disparate brands. They buy a funeral home, they don't rebrand it. Obviously they'll have some cost synergies and may be able to source some things cheaper or having, centralized back office costs. But there's no revenue synergies to gain because you're just running all these separate brands just all over the country. So you're really relying on that arbitrage between sort of public and private multiples, which can work very well, particularly if they're a smaller business. But Propel's creeping up there, nearly over half a $1 billion in market cap. And I agree with Claude, it's not cheap enough for me for this style of business. Again, a bit like OFX, I sort of worked out a bit of a cash profit number and I get about 25 times. I'd like to see that, maybe even around 15. So I'd have to fall back a fair way before I'd get, interested in a business like this. I didn't actually look at a dividend yield, as Claude was alluding to, but I'd suspect that'd be pretty low as well. That'd be another one where maybe if you were getting maybe a 4 or 5, even 6% yield, you'd be more interested. But otherwise, look, if you're there, I didn't see anything that I would sell this business, but certainly for fresh money on the sidelines, I think just that valuation, there's probably better ideas out there.
All right, Luke, Finn wants a view on 8 Common, which is, again, another platform, business software business, expense management, travel expenses for a lot of big companies and government departments.
Yeah, so disclosure, I own this one in Merewether Capital. You outlined it well, Koshy, expense management software. Historically, I think Claude might have some good charts. I'll let him talk to that. But historically, the business have been around that break-even level. They embarked on a bit of sort of capital spending to release a new product called Card Hero, which is basically digital disbursements and reimbursements. So replacing, your traditional either paper-based or reimbursement through payroll with at the point of sale digital card powered by EML actually. So they sort of embarked on a bit of a spend for this product and probably haven't seen the traction I think they would have liked to have seen quickly. That's just the nature of who this business targets. As you said, they target government and enterprise and big bureaucratic businesses or governments that just are slow to make decisions, slow to implement, slow to roll out. So I think management have been a little bit disappointed with how slow things have taken. But nonetheless, look, I still hold, there's contracts they've got with governments and enterprises where I can see this business just on what's been contracted go from about 3.5 mil revenue to double digits in the next couple of years, 10 mil plus. And I fully expect the business to tip into profitability at that point. Certainly in that expense management software can be quite high margin. But I must admit, the market has certainly been a bit impatient around that, wanting to see quicker traction and hitting that bottom line a bit faster, which is there's the chart there. So you can see the market's gotten a little impatient. The potential's there, and the contracts have been won, which is what gives me the confidence. But dealing with these governments and enterprises, the implementation, the rollout's been a bit slower. So I still hold it. I actually think it's an interesting level if someone's on the sideline and willing to take the risk of a genuine micro cap. But for me, it's a hold.
Okay, Claude.
Well, that's interesting that Luke is feeling a little more subdued about 8 Common, because I do think it is at an interesting juncture right now. I think he's covered the story really well. Where we are at the moment, it's just been a really tough time for businesses like that are still burning cash. And I did just tweet the chart that shows their receipts from customers, which are at all-time highs right now, and the fact that their free cash flow has actually been going down in the last year or so, essentially. The story here is that either that expected growth's going to come, and then at the same time, one would hope they can keep their implementation costs under control, which is why they're not getting good operating leverage. And so it's a super high risk play right now. But if it works, I think that the stock will prove to be quite undervalued right now. So with the caveat being that this is a super high risk play, and also with the other side of the story being that long term, I'm actually not convinced this is an excellent business you'd hold forever. I still think potentially at current prices, it could be quite undervalued. So to me, I guess you could, to me, I'm looking at it as a potential speculative buy right now. I don't own any shares, but it is at a low ebb, and one would hope it improves from here. That's what it should be doing, because they're saying they're spending more on implementing, which should lead to revenue in the future. But on the other hand, the more prudent person would say, let's wait and see that free cash flow pop up.
Okay, so come on. Are you putting it as a spec buy?
I'll put it as a spec buy,
okay.
But really just speculative. Yeah, absolutely.
Right. Yeah, no, we'll put the caveat on it. Claude Holly wants a view on Volpara, health technology, New Zealand company in medical device software, but particularly in breast imaging analytics seems to be its sweet spot at the moment. What do you think of Volpara?
Yeah, so Volpara is a company that I have followed since listing. I think it's a great business that really helps capture potential breast cancers earlier than otherwise would be the case, thus saving people's lives. The problem is, I was just looking back over my notes that I had a few years ago when I was making forecasts for this company. They've done fairly well on the actual growth in receipts from customers. It's just the fact that they have had what I would argue is like poor cost control, or just not wanting to cut costs or have as much discipline as they probably needed there. And as a result of that, that's why the share price is down so far, because, it just looks like even in this most recent quarterly, the net operating investing cash outflow was up. Now, it's good that they're tracking that. That's important. But that, is up again above 3.5 million for the quarter. You've just got this situation that doesn't work in the long term, which is where you keep on growing revenues but you just don't get any operating leverage there, and costs keep going up. So now there's a new CEO in. I really admired the prior CEO. I think he was more in the growth mindset of just getting the business to scale. And now there's a new CEO coming in. These guys are a substantial business. They have 34 million in New Zealand dollars of annualized or contracted annualized recurring revenue. That should be able to be profitable. And she's talking about taking, I think it was up to $8 million annual costs. Yes, up to New Zealand, $8 million annual costs out of business by FY 2024, basically. So if they can do that, the business starts getting towards break even, and then it becomes a really interesting proposition. I almost considered buying recently in June when it actually went below its original IPO price. I think was 50 cents. And the stock, after all these years, when it's gone from 1 million revenue to 30-something million revenue, was actually below that IPO price. I thought, just based on that alone, I should buy. I didn't buy. I'm sitting on the sidelines because I want to see the free cash flow go in the right direction. Is it that much to ask? And this quarter, they broke my heart again, and it went in the wrong direction. So there I am, just waiting for the fundamental improvement, because I want to own this business, but they just need to please get the costs in control.
Well, that is a good discipline for all investors who follow it. You fall in love with the stock, but you want to see it deliver free cash flow. If it doesn't, you just don't go in.
Exactly. Even though the stock price, I thought I first bought this years and years ago at under 50 cents, but I think I've made a profit because I took some off the table when it was flying high, and I don't own it now because basically, you have to keep valuing it. Of course, it has done capital raisings that time as well. I still support this business, and I hope that it succeeds, and I hope to be a shareholder again. Just need to see, free cash flow coming at least. Still
on the watch list. Luke, what do you think about Volpara?
It's actually one I've never looked too closely, and the main reason why, as Claude alludes to, when I do open up quarterly reports, even just a superficial look, I've just never seen that leverage come through. Even as receipts and revenue has increased, losses have only accelerated alongside it. Now, new CEOs come in, and I read the same announcement Claude did, the recent strategic review. That sounds really positive, and it's the path they need to take, taking some costs out of the business. Hopefully they're not cutting too much muscle out. Maybe there is some fat there that's sort of built up over a few years. So fingers crossed, can still grow strongly even on a bit of a reduced cost base. Look, the biggest issue I have is sort of, as Claude alluded to, it's I need to show me the money sort of thing, Koshy, where the strategic review, the new CEO is sort of saying they can hit that free cash flow positive mark by fourth quarter 24, so about 2 years, and think they can do so with the current cash in the bank, which is only about, I did jot it down, 15 mil. But as Claude said, I mean, with the current cash burn at 3.5, and that accelerated, the maths to me just doesn't make sense. I still think there's another capital raise here somewhere. If not, you'd be cutting it extremely thin. So I think Claude's got the right idea. You can certainly be interested in this business, put on your watch list, keep an eye on it because it's in the right space. But just, you just sit back and make sure that strategic review, that path is, they're sticking to the path they said they would, and you can jump in at a later date.
Okay, all right. Let's recap the first 5 stocks. Friday, small cap picks, Global Health from Luke and Alcidion from Claude. Smartgroup, no from both. According to Luke, if you're in it, yep, still worth holding it. Nothing wrong with the business. Very similar with OFX, same opinion from both. Propel Funerals, a no from both. 8 Common, a speculative buy from Claude, a hold from Luke, and Volpara is a no from both as well. The call is tracking its own high conviction fantasy fund, which is picked by our investment committee. The latest episode of the committee meeting is the monthly meeting is up live for you to watch on ausbiz.com. Let's check how the portfolio, the last meeting heading into August. Ordinate was removed to take some profits. Oz Minerals added, and the holding in Woodside was increased, and we'll update you next week on how the portfolio is travelling. So keep sending in your requests to the call, because that's the first filter for stocks to get to the investment committee.
The Last Call is brought to you by AVL Wines. Invest in the home of Australia's premium wine, spirit, and ready-to-drink cocktail brands.
Join us this afternoon, 3:45 Eastern for the call, where we get a lot of our experts in to have a drink and just chat about the market. This half hour, second half hour of the call, we'll be chatting about Cluey, Medical Developments International, TZ Limited, Silk Laser, and also Earlypay. Claude Curvett wants a view on Cluey, the big edtech tutoring and educational support group. Curvett says, I bought the stock during the pandemic, struggling to understand why it's underperforming. From the panel, revenue growth has been strong, strong growth in customers, small debt, strong cash on the balance sheet, and a strong internal shareholding. Can you see if I should be patient on this or just cut my losses and move on to better things? Good questions from Curvett.
Who should jump in? Sorry, it's me.
Yeah,
sorry.
Claude, yeah.
Yes, so absolutely. Look, they're good questions, and I think to answer it bluntly, it's the reason it's probably down is because it doesn't make a profit and it's got the cash burn. And in the last 6 months, basically all the companies that have those features have been down. And I should also say here that I have, I guess in a way, it's a conflict of interest when talking about Cluey, because I own shares in one of their competitors of sorts, which is Kip McGrath Education. So I guess keep that in mind. But look, the thing for me when I look at Cluey is I'm sitting there scratching my head, because I just don't know how they have license to lose so much money in trying to attract customers to their online tutoring business. So if we look at their most recent quarterly, they had 11.2 million in receipts from customers and staff costs, which, is basically just to deliver those lessons, of almost 10 million. So really not a very big gap between how much they're bringing in, selling a service, and how much it's costing them to provide that service. And in the meantime, in the last 12 months, they've burnt through, just about 17 million, a little bit more than 17 million in cash in building this business. And yeah, they're getting some real scale, and that's great to see. But that's a lot of cash burn. They've got about 24 million in the actual bank account. I guess as an analyst, my primary interest in Cluey has just been how long will people keep giving them money to do this?
Yep.
Because they spend, in the last quarter alone, 3.6 million in advertising and marketing. That's bad for Kit McGrath because it's a money-losing business just throwing money at advertising. That's never good to have in a competitor. In terms of actually investing in the competitor myself, I'm not keen on it at all. But it does amaze me that
you've got a good take on it because you're already in a competitor, so you know the financial benchmarks of a competitor, and obviously you've chosen Kit McGrath, same sector, better run business.
Well, yeah, it's a very dear. I wouldn't be so mean as to say that Cluey is. I do think it's better run. That's true. I'm not saying Cluey's bad, but I much prefer Kit McGrath because they're growing in a more measured way, still trying to grow multiple growth initiatives, but they're also mostly being profitable. They've also paid a lot of dividends over the last few years. That kind of thing I love to see. And so I know that it's a sustainable business, even though there are ups and downs in business. This one has been around for 50 years. These guys, Cluey, they are losing a lot of money. I would be interested in having a look at them once they stabilize and start making a profit.
Okay. Luke?
Yeah, look, I own Kit McGrath also. I think it's come up a few times. So I sort of suspected Claude and I have a similar outcome, which is we both prefer that. But I agree. Look, I think there's a lot of reasons to look at Cluey and have it on your watch list. The growth being the main one. I mean, the business is like, more than doubling year on year. Now, I suspect an element of that is you're probably selling $1 for 50 cents. You look at that cash burn. And I think it's pretty difficult to argue that there's, at some point I think they'll have to raise prices on their core offering. Just as an example, they charge like $80 for a one-on-one lesson. And so Kit McGrath's somewhere around that sort of number as well, but they split that across 5 or 6 students. So just at a gross profit level, you bring in more revenue per tutor than that one-on-one. So I think that's the biggest issue I see with Cluey. It's certainly that build it and they will come model where you burn a lot of cash, that venture capital model of burning a lot of cash early on to try and build a platform or a brand. But the market's turned so quickly for businesses like this. So, I've got it on my watch list, and I do look at Cluey every time they reports just because of that Kit McGrath. Always keep an eye on what competitors are doing. If I owned Cluey or was on the sidelines looking at it, similar to Volpara just before, I just need to see more evidence that you're working towards that break even, because it's just not coming through in the numbers yet. And that cash balance, it looks healthy, as Kervit pointed out, but with the burn, I mean, it's not a huge runway. It's probably only about a year or so. So, for me, I'd prefer Kit McGrath if you want exposure to the space. Otherwise, I'd just sit on the sidelines and, like Volpara, just you don't have to be there before the business sort of tips into a sustainable position.
Okay. Luke, Hannah wants a view on Medical Development International. After its latest update, Hannah's think you're buying. It's a healthcare company mainly in pain relief and asthma, but it's famous for the green stick that the Pentrox that most paramedics will shove in you if they pick you up and trying to expand it into the US.
Yeah, well, thankfully enough, I've never had to use the product, Kosher, the green whistle, but I have seen it in action, playing local OzTag here on one of my mates. And it worked. Look, I can vouch for the product from that point of view. It's an interesting business. I suspect Claude will probably know this a bit better than me. I know he's written it up for Rich Life a few times, and I've always kept half an eye on the business, but have never owned it or looked really deeply into it. They've just raised capital, $30 million at a $2 price. So that sort of shores up the balance sheet. But, you sort of look at where the price has been, even on recent years, like the last year or two. Probably if you're an existing holder, you probably would have liked a bit of a better price than the dilution you're getting at $2. Although it is entitlement right, so you can sort of maintain your ownership, and I think there's also some options that goes along with it. The biggest thing I noticed, though, looking at this business, is it used to be profitable. Not much, like a mil or two a year, sort of between FY18 to FY sort of 20 pre-COVID. But it's now swung into some pretty heavy operating losses. And like I said, Claude will know it better, so I'll let him maybe fill in some gaps. I suspect it's because they're switching to a direct selling model, a bit like Nanosonics, where you're taking on all the costs of that distribution yourself. They talk about fleshing out their European sales team, and in particular France, trying to drive some sales there. So, a lot of upfront costs need to come on to build all that infrastructure out before you can obviously sell into it. The big catalyst for this one, even just sitting on the sidelines, you've always been told the big catalyst is that US approval, the drug that's used in Penthrox, I believe is actually banned in the US, but they're trying to get that overturned because of the way that it's used in the green whistle being different to the reasons why it was banned in the past. So that's always been the big catalyst. But I do note that even in the capital raise presentation yesterday, they've sort of said that trial that they were going to run in the US has been pushed back to calendar 2023. They're hoping to do it sort of late this year. So maybe a bit of a delay there, not the best either. Look, I don't own it. If you're there, I guess you would keep holding it. I mean, the business hasn't done anything to make you sell it. But if you don't, I think it's one you can keep on your watch list. They're sometimes great businesses when they work, these medical device businesses. But again, similar to Volpara, Cluey we were just talking about, those operating losses are so steep that you just don't have to be there this early, I suppose. You can sort of wait to see some more traction come through.
All right. Claude, what do you think?
Yeah, so Luke's correct in his suspicion that the build-up of costs and therefore the commensurate losses are a result of taking control of their distribution in Europe, which is now showing some positive signs that it may be working, and also this process of trying to get their product, the Green Whistle, approved in the USA. And it's not banned there anymore. They've just gotten permission to do their clinical trial, but it's still a long way away from being able to be sold there. The only other thing I would add is there's a mea culpa in order here, because I was on the call, a year ago or something, and thought this was a buy at more than twice the price. And I've bought some myself, and actually I'm sitting on a loss on this one. And the reason that I got it wrong is because the costs, I underestimated how much it was going to cost for them to do the changes they wanted to do in terms of the European model and also in terms of the FDA. And it's looked quite disappointing to me that they are raising capital at the current price. The good thing is it's sort of done in a way that's fairly, so I can just put in a little bit more money if I want to maintain my position at the same price. I haven't decided if I'm going to do that yet. I'm also just a little bit down on myself with this one. I still personally do think that at maturity, these guys will probably have a really nice business that's worth a lot more. The leadership changed a couple of years ago. It's now Brent McGregor and Gordon Naylor. They worked in the Seqirus division of CSL, where they took it from a loss-making venture into a profitable one. So they could do it again. And there's also another person from CSL that came in around the same time, or a little bit later, Mary Sontrop. So I do think that there's a good team leading it. But yeah, look, it's been a disappointment for me so far, and I initially paid too high a price. So I guess I'd call it a hold right now, because yeah, I'm not quite sure how much it's going to cost for them to turn it around and get it going in the US and in Europe. But once they do, I think it'll be a really good business.
Okay. All right, Claude Sol wants a view on TZ Limited. He says, can Claude and Luke give me their view on this? Sold out a few months back due to low conviction. Still interested in the story. Seems to have innovative and usable technology across a range of sectors with a range of big customers. Is it just a story? Says Sol. I'm not worried about liquidity. I'm only 19 years of age and don't have much relative access to capital anyway, but it's in the development of intelligent devices and smart device systems. Claude, what's your advice to Sol on this?
I think it's an interesting one to look at and to follow. To me, it's actually been listed quite a few years, and it's a little bit of a gunner company that I don't really believe really has. I have in the past had, I just had in my notes that I had some I guess, questions about how comfortable I was with all the governance and stuff, but I don't really want to get into that now.
Yeah.
But I had it in my notes from years ago, a little bit of, I'm not 100% sure that it's my favorite kind of business to invest in, and it has had a bit of an up and down history in the past. So it is one that I would probably sit on the sideline at best. But at the same time, I have to admit that I did look at the most, recent quarterlies, and you could argue that there's some improvement there. But yeah, I'd wait until this thing becomes a profitable business and well established, more well established than it is now.
Lou?
I agree with that. I think Sol's got the right idea. Just sit back and watch this. The main reason I've got it on my broader watch list as well, Koshy, even before Sol had written in. The main reason why is that when you go up into mid and large caps and you have businesses that have underperformed for a while but are starting to turn around, they're very well covered. You've got a ton of sell side brokers, some larger funds who own it. The potential of that turnaround is recognised very quickly, and the price often gets ahead of the turnaround. But when you come down to these micro caps, that's not the case. And so you have the benefit of actually sitting back and waiting for the turnaround to come in. And you can often get one or two, earnings reports where you really see that momentum come back in, that swing to profitability. And the share price could still be at levels currently like where they are today, around that 10 cents. So take advantage of that, Sol. Like as you said, you're younger with limited capital. You can sort of play in these illiquid areas. The one benefit you've got is that there won't be a flood of capital coming into TZ as that business turns around. So you can afford to wait. I agree with Claude. The last update looked really interesting. They were talking about a record half for revenue. They were calling out potentially $2 million of EBITDA profit. If I backwork the cash result they fell short of that unless there were some working capital movements in there. So I need the full year report to dig into it a bit more. But again, that's the benefit we've got, Koshy. You can sit back, you can watch it, you can wait for the report, confirm that sort of turnaround that you're waiting for happens. And I guarantee the share price, it won't be like a large cap where it can be up 50, 100% before it happens. Micros, you can really wait.
Right, keep a watch on it. There you go, Sol. Thanks for sending that in. Look, Jason wants a view on Silk Laser Australia. They're in the skincare, laser hair removal, skin treatment clinics all around the country. What do you think of really cosmetic surgery people, aren't they?
Yeah. Look, this has come up for me, I think, 2 or 3 times on the call, and every time I've looked at it, I sort of come away with the same conclusion, which is it's not my style of business. We're talking about it with Propel before. I'm not a big fan of these roll-ups, but if you were sort of interested in the business, there's a lot to like. Even just comparing it to Propel before, it's much cheaper. Trades on I said Propel was about 25 times cash profit. These guys are closer to 10. And like I said before, with roll-ups, you sort of want to get them early on, where an acquisition that they make can just be much more accretive to a smaller base than a larger base. So Propel, being a 500 mil market cap business, really needs to go out and make 10, 20, $30 million acquisitions to really move the needle on their earnings. Whereas Silk, 143 mil market cap, they can go out and buy, a range of centres. The recent one they did was 8 centres. That can still move the needle for them just on a store basis, just because they're coming off that smaller base. Recent articles in the AFR that one of their competitors, Laser Clinics Australia, it's owned by KKR, the private equity firm. They had to buy back a bunch of clinics from some disgruntled franchisees. And I don't think it's any coincidence that if you look at the latest Silk Laser announcements, they talk about it being, they recently got 5 stars by the Australian Franchisee Association or something like that. So I think they're trying to play off, we're doing much better than one of our peers from that point of view. Look, like I said, it's not my style of business. So, I probably won't say buy Koshy just because, I like Claude. I prefer those compounders I can see over many years, and the history of roll-ups on the ASX, they struggle to do that over the really long term. But just from a more strategic or shorter term point of view, I think this is a stock you'd actually do pretty well out of over the next maybe year or two. But you've got to watch them so closely, which is sort of why I tend just to stick away. But I'd hold it if you're there for sure.
Right. Okay. Claude?
Yeah, so this is one that I guess could be interesting. I think it's probably a little bit too much of a recent listing for me to go into it, just because I think when you have a roll-up like this, it's very hard to get a real understanding for the way the business will react throughout the economic cycle, or even just during ups and downs, if you hadn't had a long time to look at it. I also think you have the exact same concern with franchise models. some franchise businesses are quite good. Some have actual real struggles. There are issues with that all over the place. I'm not saying that this one's bad at all, but I just want a longer period of time. But I did think that the point that Luke made about it being smaller and then having more legs in that growth from acquisition strategy, I think that is true. And it wouldn't be crazy to try and ride that. And that's the typical thing with roll-ups or at least roll-outs as well. You want to kind of get in early. And I could imagine that there's a lot of demand for this kind of business. Hard for me to really tell myself. I'm not closely tapped in with those kind of retail trends. So for me, I'd probably sit it out, just at least give yourself another couple of years or just 1 year now, just to see how this business reacts when we have a bit of a bumpy economic time.
Okay. Our final stock, Claude Wren wants a view on Earlypay. Now, people would go, oh, no, not a buy now, pay later. Well, it's not. It's sort of invoice financing business, isn't it?
Yeah, so that's right. And I think that we may have talked about this before, but I essentially like it. I don't have all of my stocks in like little exciting growth stocks. Some of them I look for are dividend companies. And this to me looks like one of the more impressive or generous dividend yields on the ASX.
Right.
On top of that, I'm also looking for that kind of alignment. So I bought in, so I own some shares myself, and I bought in after one director bought $100,000 worth of shares in November last year. And you can also see that the founding family own a lot of shares in the business. So I think there's alignment there, and it's also been listed for quite a few years, if we even look at the 5-year chart. So generally speaking, I think in these lending businesses, because you always face a risk that when they're lending money on the basis of an invoice, if the person doesn't pay that invoice, then it's Earlypay that's going to lose out. Yep. So there is risk in this business, and they make money by taking on that risk. But when you're dealing with this kind of risk, it's good to have aligned management with a long-term history of managing the company. And once they've got that, as long as they don't blow the company up and keep, carefully growing it, if they can then pay out a decent, nice dividend yield to shareholders, that's exactly what you want to see, because that's how you're going to make money holding it. So that's why I own it. It's a dividend stock in my portfolio. It's not without risk because it is part of this lending industry. Okay.
And it's sort of same, but different to Credit Corp, is it?
So Credit Corp buy in most of its business. Yeah, it's similar to part of Credit Corp's business, yes. I think, but most of Credit Corp's business is to do with buying debt. That's not quite the same, but it is actually similar, where they're just sort of, in a way, they're buying the invoices, right? You could put it that way in your head.
Yeah.
But that's essentially, it is that sort of shorter term lending. So they can be quite a good business, and one would hope less exposed to people not paying, but you do have to keep an eye on those bad debts, because that can really hurt any lending business.
Luke?
Yeah, look, disclosure, it's a small position for me as well in the Merewether Fund. I agree with Claude. Look, it's objectively cheap, sort of 9 times earnings, 6.5% yield, but also some good growth in the business as well, organic and even potential for little bolt-ons they've made in the past. I sort of, in my mind, I don't expect the business to attract much more than, maybe a 9 to 10 times multiple yield. So, I expect capital growth to come from the business itself. But the yield, of course, it can be so capital light from an equity point of view, because it's as Claude said, it's debt finance on the balance sheet. So you can pay out a nice, healthy chunk of your earnings without having to retain it. So from that point of view, look, I think it looks cheap, gives you a good yield, as Claude was talking about as well. I agree with his points. The main risk is just the exposure to essentially small, medium businesses as we go into a more uncertain macro environment. I actually think the invoice financing aspect of the business is probably not as exposed as what some people may think, because oftentimes your debt, you buy the invoice off a small business, but it's actually the business that's paying that invoice that you're taking the credit risk with. Yes. And oftentimes they're actually larger businesses, and it's just that these small businesses are on terrible payment terms because they're dealing with these large enterprises. The segment I'd be a little bit more careful or just keeping an eye on. They do some equipment financing as well, which that's a space on the ASX. Even think back to a Silver Chef or an Access today. There's a few blow-ups in the ASX cemetery in that equipment finance space to small businesses. So it's one I watch a bit more closely whenever they report. But, as Claude said, and Credit Corp's a great comparison, Koshy. When you're going to go into these small business finances, you want management teams who have been through a few cycles, and both Earlypay and Credit Corp have, and that's why you've got faith in them to manage the business through whatever headwinds we may be facing.
Yeah. So what do you think of it?
Look, I'm just holding it for Merewether. To be honest, look, if I didn't have a position, I could, anything under sub 50 cents, I think is a good price to buy. You probably wait till after the report now, because we're, probably 2 weeks away from the report. So you could just easily wait for the report, see what the numbers are, see what the outlook is, and buy on the back of that. But yeah, this is one I think gives you a great mix of growth and yield. It's fantastic for that.
Good analysis. Luke Winchester from Merewether Capital. Great to see you, mate. Claude Walker from A Rich Life. Good to see you. Have a great weekend. Catch you next week.
Thanks for having me.
All right.
Thanks,
see you guys. All right, let's just recap the final 5 stocks. Cluey, a no from both Claude and Luke. They both prefer Kip McGrath in that space. Medical development, a hold from both. Luke has it on its watch list. A no for TZ. Silk Laser, a no from Claude, a hold from Luke, and a hold on Earlypay from both of them. If you'd like any stocks for me to put to our expert panel on any day, email them in, the call at ausbiz.com.au, or tweet us using the @AusbizTV handle. And a reminder, you can see all the stocks in the Calls Fantasy portfolio. Head to ausbiz.co/portfolio. Coming up next, the small caps.